Hi, welcome to our June market report for Huntsville and Madison County. Yeah, I'm in a tropical shirt today. It's June in Alabama. It's 100 degrees, but people aren't talking about the weather. They're talking about mortgage rates, and we're going to do that too. How does that affect our housing market? Let's take a look. Well, here we are almost halfway through the year. It's hot in Alabama, and we're talking about rising mortgage rates. Let's take a look at how that's going to affect our market here in Huntsville and Madison County. As you can see, mortgage rates have been on a steady rise from the beginning of the year. Last couple of weeks, over 5%, coming from a low in the high twos toward the end of last year. Mortgage demand has fallen to the lowest level since the end of 2018. That's pre-pandemic demand for mortgages. And in this note, it said interest rates have eased a little bit, but they bounced back up, as we'll see here shortly. But even at 5% or 6%, if you look at historical rates, 5 or 6% is still a pretty good mortgage. As a matter of fact, over the last 5 decades, 5 or 6% is the best mortgage rates we've seen in that generation. For almost 50 years, the 30-year mortgage rate has run in tandem with the 10-year Treasury bill. So if you don't see mortgage rates in the news that you read or the reports that you listen to, you can watch the trend on the 10-year Treasury bill to see which direction mortgage rates are headed. Historically, over that last 50 years, they've averaged a delta of about 1.7%, meaning that the Treasury bill yield has been about 1.7% less than the 30-year mortgage rate. But just recently, as of yesterday, 30-year mortgage rate surged to over 6%, 6.28%, up from just 5.5% a week ago, and the Treasury bills topped at 3.8%. So you remember that delta of 1.7 between the two, now it's 2.8%. So that means that these rates are out of whack. It's probably clearly an overreaction in the mortgage market to the potential of a 75 basis point rate hike by the Fed. Concerned about future inflation and future interest rates going higher. They're always going to err to the side of caution, which means they're going to raise rates higher than they need to be. It's very possible that that 6.28% could be a short-term peak in mortgage rates. We'll just have to wait and see. But for the U.S. home sales rise for the first time since 2019, that means that our inventory is now moving back toward inventory levels that we had pre-pandemic. For the first time in 3 years, we've seen a rise in inventory. Now, real estate is local. All real estate is local. So some of these areas that they're showing in this chart have had some significant increases in their inventory over the last year. But housing inventory is still in a crisis level. We still don't have enough homes. You can see for our local market here in Huntsville and Madison County over the last 3 years, we're on a pretty steady decline. You see that it looks like maybe we bottomed out in inventory earlier this year in February and March. If we look at just the last 12 months, you can see we have about the same inventory today, 395 units, as we had about a year ago, 399 units. But this emphasizes that bottoming process potentially in February and March. And in the short run, our inventory is back on the rise. But it's still only 1 month or less of inventory. And as you remember, we talk about almost every month. A normal real estate market is about 4 months of inventory. 3 to 4 months of inventory is a normal market. Over 4 months, you may have been moving into a buyer's market. Under 3 months, you're still in a seller's market. So we're definitely still in a seller's market. Consumer sentiment is at a record low. Inflation is at a record high. Both of these have negative impacts on demand, but that's something that we need in this particular market. This is a quote, the one that I agree with the most of all the things we've looked at over the last month, and I've highlighted the part that is most pertinent. Heading into the summer, the potential home buyer pool has shrunk. That is correct. These higher interest rates, higher inflation, lower consumer sentiment, people that don't have to buy a home are going to postpone looking for a home. If they've just been dreaming about a home or thinking about buying a home, especially this week with rates running up over 6%, they're not going to jump into the housing market at this point. People buying homes are going to be investors that have cash that they have to deploy, or they're going to be individuals that have to have a place to live. That's going to be the buyer's market for the next 3 to 6 months probably. Supply is on the rise. That is true, not significant, but it is moving in that direction. But here's the big takeaway from our whole report. All of these things mean that the housing market is normalizing. It doesn't mean that we're in a boom and we're about to crash. It doesn't mean prices are going to drop. It doesn't mean the bottom is going to fall out. It just means that we're moving back to a normal housing market like we had pre-pandemic. If you look at the showings over the last several years, you can see how they skyrocketed during the pandemic over the last 2 years, 21 and 20 and 21 and 22. But you can see that starting in April, they're starting to decline. When we get May and we get June, I think they'll go down even more because it is a little slower out there. We can tell definitely than it was a few months ago. But all we're doing is moving back to these pre-pandemic levels. We're moving back to a normal market. This market was abnormal. It was atypical. We've said month after month it is not sustainable. You can't sustain 20% year-over-year gains for housing over a long period of time. So we knew that that was not going to continue. Existing home sales, moving back down at an annualized rate in April of 5.6 million units. That's about the rate of sales that we were at before the pandemic. 5 or 6 million units a year. Now you see in 21, our last full year that we have the record for, last year, we sold 6 million homes. Well, this year the forecast, the worst forecast out of the major companies that do those forecasts, is for 6.1 million home sales. So they're looking for about the same number of homes sold this year as we did last year. The housing market is at a turning point. We are seeing signs in a new direction, but it's still in the seller's court for most housing markets, and that's the way it is here. So what do we expect to see for the next 3 to 6 months? Well, what we expect in our market is for prices to stabilize. We're certainly not going to see the 20% year-over-year gains that we've seen for the last couple of years, but we're not going to see any significant price decreases either. We should be moving back to the 3 to 4 to 5% a year appreciation that a normal real estate market sees. Interest rates are going to remain volatile. It's very possible that we've seen a short-term peak in interest rates in the low 6s. If you're buying in this market, you're going to need to pick your points of entry when you move in and lock your rates. That's the best thing that you can do, and possibly you'll be able to refinance in a few years at a lower rate. The demand is going to be slower, especially in the lower end of our market. For the first-time home buyers that don't have to have a home but were wanting to move into the housing market, this has been a tremendous shock. They're going to move away from the market. They're going to have to recalibrate, requalify, get a new price target in mind, and it's going to take them a few months before they decide to start looking at homes again. Inventory is going to increase. Even though I don't think it's going to be significant, it is going to move in that direction, but we are still firmly in a seller's market. We have now less than 1 month of inventory in the market. We have to get up to 4 to 5 months, 6 months of inventory before we flip into a buyer's market, and that's a long time away. If we can help you with any of your real estate moves, please reach out. We have all of these resources available on the website. The links are in the description below. Call us if we can help you, and let's have a great month.
Oh.